Why did the 2008 housing market crash happen? The 2008 housing market crash was caused by a combination of reckless lending practices, financial deregulation, excessive risk-taking, and the bursting of the housing bubble. The widespread belief that home prices would never fall fueled risky behavior, and when the housing bubble burst, it triggered a financial crisis that spread worldwide. Below are the key factors that led to the collapse. The rise of subprime mortgages. Subprime mortgages were home loans given to borrowers with poor credit or unstable financial situations. Lenders lowered lending standards, offering loans with little or no income verification, no down payments, and adjustable interest rates that later skyrocketed. Many borrowers could not afford their loans, but banks issued them anyway, assuming home prices would keep rising and borrowers could refinance later. Financial deregulation and Wall Street's role. In the late 1990s and early 2000s, deregulation allowed banks to engage in high-risk investments without proper oversight. Investment banks bundled risky mortgages into mortgage-backed securities, MBS, and collateralized debt obligations, CDOs, complex financial products that were sold to investors worldwide. Credit rating agencies like Moody's and S&P wrongly rated these risky assets as safe investments, misleading investors. The housing bubble and unsustainable growth. Due to easy credit and speculation, home prices skyrocketed between 2000 and 2006. Banks and mortgage lenders encouraged house flipping, allowing buyers to take on multiple loans with the expectation that home values would continue to rise. This led to a massive housing bubble where home prices were artificially inflated beyond what buyers could afford. Adjustable rate mortgages, ARMs, and payment shock. Many subprime borrowers received adjustable rate mortgages, ARMs, with low introductory rates, teaser rates. When the introductory period ended, interest rates spiked, and monthly mortgage payments doubled or tripled, making them unaffordable. As a result, millions of homeowners defaulted on their loans, leading to a wave of foreclosures. The domino effect: foreclosures, bank failures, and economic collapse. Home values plummeted as foreclosures flooded the market, making it impossible for homeowners to refinance or sell. Banks and lenders took huge losses as mortgage-backed securities became worthless. Major financial institutions collapsed, including Lehman Brothers, bankruptcy, Bear Stearns, bailed out, AIG, government rescue. The stock market crashed, wiping out trillions in wealth and triggering a global recession. Government intervention and aftermath. The U.S. government stepped in with the Troubled Asset Relief Program, TARP, and $700 billion bailout of banks. The Federal Reserve slashed interest rates and launched quantitative easing, QE, to stabilize the economy. Stricter regulations were introduced, such as the Dodd-Frank Act, to prevent another crisis. Protecting yourself and your buyers from predatory lenders. Watch out for lenders who engage in unfair, deceptive, or exploitative lending practices. Requires awareness, due diligence, and smart financial strategies. Here are some key ways to protect yourself from falling victim to predatory lending. Know your rights and recognize red flags. Familiarize yourself with your legal rights under federal and state laws, e.g., the Truth in Lending Act, TILA, Home Ownership and Equity Protection Act, HOIPA, and Equal Credit Opportunity Act, ECOA. These laws protect consumers from deceptive practices and ensure you receive clear information about loan terms, interest rates, and fees. Red flags to watch for: excessive fees. High fees, especially when not fully explained, can be a sign of predatory lending. Pressure to act quickly. If a lender pushes you to sign documents without giving you time to review them or consult with an attorney, that's a major red flag. Excessive prepayment penalties. These penalties make it costly to pay off a loan early, often trapping you in unfavorable terms. No credit check or no documentation. A lender who offers loans without considering your ability to repay or asks for minimal documentation might be a predatory lender. Shop around for the best loan. Compare multiple lenders. Shop around with different banks, credit unions, and mortgage lenders to find the best loan terms. A reputable lender will offer competitive rates, clear terms, and fair fees. Check the APR, annual percentage rate. The APR reflects the true cost of the loan, including interest rates and all associated fees. Higher APRs may signal predatory lending, especially if the lender doesn't provide a reasonable explanation for the high cost. Understand the full terms. Always ensure you know the full terms of the loan, including the interest rate, fees, and penalties. Beware of adjustable rate loans with steep rate hikes after an initial period. Be cautious of high-interest or subprime loans. Avoid subprime loans if possible. Subprime loans are given to borrowers with poor credit histories, but they often come with high interest rates and unfavorable terms. If you can, try to improve your credit score before applying for a loan to qualify for better rates. Seek government-backed loan programs. If you are a first-time homebuyer or have a lower credit score, FHA, VA, or USDA loans often offer more reasonable terms compared to subprime mortgages. Get a second opinion, consult a financial advisor or attorney. If you are unsure about a loan offer, it's always a good idea to consult a trusted financial advisor, mortgage broker, or real estate attorney. They can review the loan terms and identify any predatory clauses. Ask a trusted friend or family member. Having someone with a better understanding of financial matters review your documents can help you spot potentially exploitative clauses. Read and understand all documents. Before signing, don't rush through the paperwork. Predatory lenders often try to push borrowers into signing agreements without fully understanding them. Always take your time to read and understand all loan documents, and don't sign anything you haven't had the chance to review. Request clarity. If any terms or fees are unclear, ask the lender for a full explanation before moving forward. Avoid loan flipping. Loan flipping occurs when a lender encourages a borrower to refinance a loan repeatedly, often with increasing fees and interest rates. This keeps the borrower in debt and unable to pay off the loan. Stick to a reasonable refinance plan. Avoid refinancing too often or with loans that come with high costs or predatory terms. Report predatory lending practices. If you believe you've been targeted by a predatory lender, file a complaint with the Consumer Financial Protection Bureau, CFPB. The CFPB handles complaints related to unfair lending practices. State attorneys. General. Many states have consumer protection laws that can investigate predatory lending claims. The Better Business Bureau, BBB. You can report misleading or unethical lenders to the BBB for investigation. Consider working with a HUD-approved housing counselor. If you're unsure about your mortgage options, you can seek assistance from a HUD-approved housing counselor. These counselors provide free or low-cost services to help homeowners navigate their options and avoid falling into the hands of predatory lenders. Conclusion: empower yourself with knowledge. The best way to protect yourself from predatory lenders is to be an informed borrower. By shopping around, understanding the terms of the loan, consulting experts when necessary, and recognizing red flags, you can avoid many of the dangers posed by predatory lending practices. Always remember, if a deal seems too good to be true, it often is. Stay vigilant and know that you have legal protections to help safeguard your financial future. What is and when did the CFPB happen? The Consumer Financial Protection Bureau, CFPB, is a U.S. government agency responsible for protecting consumers in the financial sector. It was created in response to the 2008 financial crisis as part of the Dodd-Frank Wall Street Reform and Consumer Protection Act of 2010. Why was it created? Before the CFPB, consumer financial protection was spread across multiple agencies, leading to gaps in oversight. During the 2008 crisis, predatory lending, deceptive mortgage practices, and weak regulations contributed to massive foreclosures and economic turmoil. The CFPB was established to centralize and strengthen consumer protection in financial products like mortgages, credit cards, student loans, auto loans, banking services. What does the CFPB do? Enforces consumer protection laws against unfair or deceptive financial practices, regulates financial institutions to ensure transparency and fairness, investigates complaints and provides resources to help consumers understand their rights. Issue rules to prevent predatory lending and abusive financial products. The CFPB has been both praised for its consumer advocacy and criticized for its regulatory power, but it remains a key player in protecting financial consumers today. Arizona laws against predatory lending. Arizona Revised Statutes, ARS, Paragraph 6 to 909 prohibits certain unfair lending practices for mortgage brokers and lenders, such as making loans without considering a borrower's ability to repay. Protects consumers from excessive fees and high-cost loans. ARS, Paragraph 44-1211, Unconscionable Contracts and Conduct, prohibits unfair, deceptive, or fraudulent practices in financial transactions. Borrowers can use this statute to challenge predatory lending terms. Arizona Home Loan Protection Act, AHPLA. ARS, Paragraph 6-1141, Paragraph 6-1143. Limits high-cost home loans by capping fees and restricting abusive loan terms. Prohibits prepayment penalties beyond 3 years. Bans negative amortization and loan flipping. excessive refinancing for lender profit.